Welcome to Introduction to Accounting, Preparing for a User's Perspective. Define common equity accounts. How is equity defined by the FASB? Equity, or net assets, and make sure you focus on this idea of net assets, is the residual, meaning the leftover, interest in the assets of an entity that remains after deducting its liabilities. This definition comes from the balance sheet equation. Assets equals liabilities plus equity. All of these assets are funded either by debt or by equity. If we want to know what equity means, we can solve for equity. When we do that, we would deduct liabilities from both sides and result in the following equation. Assets minus liabilities equals equity. Equity, or net assets, is the residual interest. As you can see here, assets minus liabilities leaves over a residual. That residual belongs to the owners. Let's look at some common equity accounts and see what increases and decreases them. Here's the list of common equity accounts that we'll be using in this course. We may add a couple more, but this is a good starting point. If you were to look at a balance sheet and you were to only see something like Kevin Kimball Capital, immediately you would know that this is a sole proprietorship, because there's only one capital account and it's named after the individual sole proprietor. Now, if you were to see two or more capital accounts with people's names on it, you would know that that's a partnership. If you were to see something like common stock, preferred stock, and retained earnings, these would represent that this is a corporation. Common stock and preferred stock are types of stock that are given to owners in exchange for resources. Retained earnings is the amount of income the company has earned and the owners have chosen to keep within the company rather than have them pay out in the form of withdrawals or dividends. Dividends would be the appropriate term if we're dealing with corporation. Withdrawals would be the word we use for partnerships and sole proprietorships. These equity accounts keep a permanent running total of the company's total equity. They appear on the balance sheet. They're known as permanent accounts because they keep a running total year after year after year. These equity accounts are only temporarily used during a given period to explain why these balance sheet equity accounts changed from one year to the next, or one accounting period to the next. Capital distributions, withdrawals, and dividends appear on the statement of owner's equity or shareholder's equity. Withdrawals and dividends are payments to the owners out of the company's earnings, and capital distribution is effectively giving them back their original capital. Revenues, gains, expenses, and losses appear on the income statement. If you take all the revenues and gains and deduct all the expenses and losses, you will arrive at net income. Net income serves to increase retained earnings. You should recall the TAccount format. It's just another way of computing an ending balance. Liabilities and equity normally have their beginning balance on the right-hand side and increase on the right and decrease on the left. The ending balance would be on the right-hand side. If we were to then look at this equity account and say, how did we get this equity? Equity usually comes in two forms. Either it's contributed by owners or it's earned through net income and retained in the company. If we were to take this equity account here and break it out into two pieces, we would get the contributed equity, which we'll give a general term capital stock, and earned equity, which we will call retained earnings. If you want to increase either of these accounts, you would record it on the right-hand side. If you want to decrease it, you record it on the left-hand side. What increases the contributed equity, capital stock account? If owners make capital contributions, that will increase. What would cause it to decrease? If the company were to distribute capital back to the owners, that would decrease their capital stock account. If they issued new stock, that would increase it. If they were to buy the stock back, that would decrease it. Over to our earned equity, retained earnings. It increases when we have revenues and gains, decreases when we have expenses and losses. These together, if you take all your revenues and gains less your expenses and losses, that would be your net income. Hopefully your revenues and gains will be greater than your expenses and losses, resulting in a net increase in equity called net income. If your expenses and losses are greater than your revenues and gains, then you will have a net loss resulting in a decrease in retained earnings. If you were to have net income, the owners could choose to withdraw it, it's a sole proprietorship partnership, or have dividends paid out to them if it's a corporation. Assets minus liabilities equals equity. When assets increase by more than liabilities, owner's equity will increase. For example, if we had $10 in assets come into the company, but liabilities were to only increase by $7, then the owners would have claim on the additional $3. When assets increase by the same amount as liabilities, owner's equity will not change. If we have that $10 come in, but liabilities increase by an equal amount, then the owners have no additional equity. When assets increase by less than liabilities, owner's equity will decrease. If we have $10 in assets come in, but our liabilities increase by a larger amount, that excess liability effectively will reduce the owner's equity in the company's assets. What transactions could explain these different examples? I've set this up. You've just barely seen this. Here's your equity accounts broken out into the two types of equity, the contributed equity and the earned equity. And the opposite side is your assets minus liabilities. If we purchase $10 of inventory on account, that means our assets increase by 10, and we bought it on account, that means our liabilities increase by 10. As you can see, the asset increase is exactly equal to the liability increase, and therefore there is no change in equity. If we were to then sell the inventory to customers for $13, we'd have to give away the inventory, so we're going to reduce it by 10. When we give away inventory to customers, that will be an expense. We'll call it cost of goods sold. As you can see here, assets reduced and equity reduced by the same amount, but we sold it for $13 on account. We'd have another asset called accounts receivable increase, and since that did not change our liabilities, that would have to belong to the owners. We'll call that revenue. The net effect is that our assets are now 13, our liabilities are now 10, no change in our contributed capital, and our retained earnings is 3. As you can see, this balances out. 3 on this side, 13 minus 10 equals the 3 on the other side. If we issued $3 in stock in exchange for a company that had $13 in assets and $10 in liabilities. So we're going to issue $3 in stock. In exchange, we got $13 in assets and $10 in liabilities. As you can see, 13 minus 10 equals 3. If we issued $3 in stock in exchange for cash, our cash would go up, and it's a stock issuance, $3. We stay in balance. As you'll notice as we go through these, every transaction we record will keep this left-hand side equal to this right-hand side. When assets increase by the same amount as liabilities, owner's equity will not change. Purchase $10 of inventory on account. We already saw this. Our assets went up by 10, liabilities went up by 10. No change in equity. If we borrowed $10 under a note agreement, our assets would go up by 10, and it's a note, that's a liability, no change in equity. If we borrowed $10 using a mortgage to purchase a home, we'd have an asset called home go up and a mortgage payable go up. As you can see, equity never changed, and so there's 0 on this side and 0 on the other side. When assets increase by less than liabilities, owner's equity will decrease. For example, if you purchase $13 of inventory on account and then sell it for only $10, hopefully you see right off the bat that this is not a great business proposition. You're buying something at a high price and selling it for a low price. But let's see what it does to the overall balance sheet equation and our net assets. Purchase $13 of inventory on account. So if you bought inventory, your assets would go up, and it's on account, meaning you haven't paid for it yet, so your liabilities would increase. In this case, equity has not changed yet. It's when you go and sell this for less than the cost, that's when the owners lose. We're going to sell it for $10. If you sell it for $10, first you have to get rid of the inventory. So your asset will go down. When you give inventory away to customers, that's an expense that we call cost of goods sold. That reduces our income, which reduces retained earnings. Then, in exchange for that $13 of inventory, we are going to get $10. Since it just says sell it for $10, you can assume it's for cash. Our assets go up by 10. Since the liabilities are not affected by that transaction, it must have increased equity. Since this was a transaction with a customer, we will call that a revenue. Let's see where we're at now. If we were to compute our asset balance, we have $10 in assets, $13 in liabilities, and we have a net loss, which reduced retained earnings by 3. Let's look at another transaction. If we borrowed $13, and then owners withdrew $3 in cash, or we paid a dividend of $3. So let's borrow $13. We're going to bring in $13 of cash. We borrowed it. No change in equity yet. But then we use this cash that we just brought in to pay a dividend to the owners. Reduce assets by 3, and it's a dividend of 3. I'm going to put it down here, but it is a dividend of 3. Let's compute our balance. We have 23 minus 3, that's 20, minus our liability balance of 26, so 20 minus 26, this is not a good sign. We do not have any net assets. In fact, we're negative. Why are we negative? Because we pulled $6 out of our retained earnings by creating losses and paying a dividend. Hopefully you can see how that all works together. We're going to move on to preparing the financial statements, but if you can get the logic of how this works, it will go a long way for your understanding accounting.